Before the COVID-19 pandemic, the South African short-term insurance market, I would contend, was on a strong growth trajectory. But then everything started changing, and the approach to risk has changed considerably. And I want that to inform this conversation right now. And a very warm welcome to you. My name's Jeremy Maggs, in discussion today with Ron de Bruijn, Managing Partner at Riskonet in the Netherlands, Chris Brits, Managing Partner Riskonet Africa and Riskonet Limited Mauritius, and Volker Von Widdern, Principal of Strategic Risk at Riskonet Africa. In case you're wondering, we're sitting in the bowels of a room at a well-known Johannesburg golf club. So if you see golf balls, if you see golf carts, if you see people behind us, you'll know exactly what is happening. Ron, to you, first of all, a very warm welcome. I think this is essentially a discussion about sentiment. In terms of risk management in Europe at the moment, what's driving the conversation?
I think the conversation is driving frustration with a lot of our clients, a lot of other companies in Europe with the insurance market. They've been confronted over the last years, since 2017, 2018, with hardening markets, increased prices, lack of capacity, without being actually pre-warned beforehand. A lot of our clients also, we're actually providing a lot of services to the big, large global corporates based in the Netherlands and sometimes outside. And what you hear from them is that they're all surprised about the insurance market approach when the market hardened. So they feel betrayed, they feel uncomfortable, they feel like, okay, what should have been done before? You never told us. So what position are we in now? How do we handle this? You see that in the discussions we're supporting the NARIM organizations, the Dutch Association for Risk and Insurance Managers. They pronounce that. It's also in the FERMA, the European Insurance Association. If you look at the articles, but also listen to the clients and the risk and insurance managers, they're all like, why didn't you tell us? That's I think, one of the main issues you hear in Europe. I'm not sure if that's the same in Africa.
Tell us about what, and we'll get to the African position in just a moment, but tell us about what, in what respect is that position hardening?
It's positioned in a way that they actually were surprised with the sudden hardening of the market, but also with the fact, and we're in the asset safety issues. So clients were suddenly informed about the fact that they should install sprinklers all over the place. Where the year before, the inspectors of the insurance companies came and it was all okay. And it was ranked average, above average, even good. And then suddenly the market changed, and suddenly it wasn't good enough. And suddenly there was no capacity anymore. And suddenly they were not able to connect with the underwriters in the country they were doing business. They had to go to the referral underwriter somewhere at the headquarters.
So, Ron, let me just pick you up on one aspect that you've just referred to, that hardening of position as far as the industry is concerned. How is that manifesting itself, and what's the consequence of that?
It's manifesting itself by clients suddenly being confronted with a change of ranking of their facilities. So before the hard market kicked in, everybody seemed to be satisfied with the quality of the risks they were assessing, they were inspecting. And then after the hard market, suddenly the ranking went down. There were sudden recommendations became requirements. Sudden things which were never recommended to the clients, to the companies, suddenly popped up. And it also led to stress with clients, because they, at the end of the policy year, they didn't have cover. So they were struggling to get capacity made available to them. And it also led to a situation that suddenly they had to start investing a lot of money in all kind of improvement solutions. Sprinkler systems, if you look at the European market at the moment, if you're a sprinkler contractor, you're in a great position, because everybody needs sprinklers.
Sure.
And it's required by the insurers. So that's clearly what affected the businesses in Europe.
So, Chris Brits, a changing paradigm in Europe. Are you finding resonance with that in the markets that you operate in?
We've been living through a very soft cycle for probably the past 8-9 years, prior to 2019. International standards have always been something that Ron's had to deal with. Whereas in the local markets, we've been subjected to local insurers who've been quite kind to clients. I think the fact that they're reining in now is fair, And I think our clients have had a very long time to meet the requirements, but have been caught, unfortunately, because of the cycle that we're in.
How does this approach, Volker, your approach then to managing and advising on risk? What's changed in the debate?
Following on what Chris said, because it was so easy to get cover and capacity and so forth, people didn't really pay attention to what kind of cover and where is it the most applicable and relevant. So you could perhaps get $1 billion or $5 billion of business interruption cover and it just would be allocated. Now, because it's expensive, you say, well, what's the right number? You know, that generic allocation and just roll over the renewal and so forth. So now one realizes that actually I need to think hard about my supply chain and whether I can keep my business going but incur what's called increased cost of working. People hardly paid attention to that before because it was so easily accessible in terms of cover. The benefit of that is now thinking about supply chain and your response strategies improves the business's ability to sustain itself.
So how do you begin that process of auditing the supply chain?
Well, we go through this risk assessment, which we call the business impact analysis. But it isn't that sort of transactional flavor that you get in business continuity. It's a thorough commercial analysis of what really goes wrong. So we ask a client, well, yeah, you may have a fire in your plant, and the standard question is, how long does it take to build a plant? 12 months. Okay, but that was 15 years ago. Is the supplier and the designer of that plant still here, still appropriate? How long does it take to warm up the drawings? And would you actually build the plant the same way? Some of those questions are similar, but the full consequences of a loss like that aren't really dealt with. Similarly, you've got supply chain dependencies of key equipment suppliers, never mind microchips. And some of those supply chain dependencies are hardly tested. Now it's much more relevant.
So, Ron de Bruijn, what sort of conversations are you having around that supply chain management?
I think it's quite comparable with what Volker said. We see the same thing. We see the awareness of companies increase. It's now combined with the fact that the global supply chain just simply failed. So you see far longer delivery periods of strategic products. Products you need to rebuild your factory. So that's an extra issue which has arisen over the last 2-3 years. So it's not only what would it normally take to rebuild your facility or to look for alternatives. It's also what does it now take to rebuild your facility. So there's a combination of factors, but it's quite comparable with what Volker actually said. We see that same thing. We support our clients also in providing them with more information and looking for realistic alternatives. So make sure that if you have a production facility which is key for you, that you either protect it optimally, so that's one of the steps we take with them, or look for alternatives. Look for other suppliers, try to modify your production in another plant in such a way that you can actually take over when that critical plant goes down for whatever reason.
The advice is critical in that respect, but you've also got to keep an eye on cost.
You know, cost is one of the reasons we find that most of our clients fail to comply in the first instance. So I think the benefit of where Riskonet fits into the market is not only the fact that it's a core competency for us, but it's a distinctive capability. In the event of a client being faced with some challenges, being able to rely on an independent source which is not connected to an insurer, to a manufacturer, to an installer, to be able to provide the client with those alternatives which are cost effective.
Volker, I'm seeing the importance of having the conversation. Is there an openness across the spectrum to engage in that conversation? Are people willing to look for those alternatives? Again, with that weather eye on cost all the time.
Yeah, so the question is yes or no. I'd say just quickly, perhaps a third of corporates have an appetite to really reconsider their approach to risk to achieve a different outcome. The interesting thing about cost is there's also opportunity. So as Ron was saying, if we need to think about supply chain, and that applies both to your products as well as to critical equipment that you need to deliver your product. Now, if we're looking at something before, that maybe collaboration wasn't as carefully considered because you got so much insurance. But now if you're in the same industry and you and your similar industry guys need to rely on another source of capacity, maybe collaboration's not so bad. You rather keep your customers and collaborate on the production side. And that's a cost factor. So I think looking at solving the problem differently is always the opportunity in risk. And so then coming back with the cost and the appetite, what we often show is that when we've done good risk analysis, we're giving far more quality information to the markets. It can reduce rates, and we'll also restructure the program so that we buy insurance at the right level. So we're not trying to insure pens and pencils. We're trying to get shareholder protection and reduce and make the cost and make the program more efficient at that level. And that is an enduring benefit for the client and gives them much less exposure to the roller coaster of the rates at the bottom of the market.
Practically, is there a different way in which you are approaching the risk analysis? How are you doing it differently?
Do it over 6 weeks instead of 2 days. Yeah. There's no short. You have to get to know the client. And it's been enormously tough on Chris and Ron's teams. There's no ways these people are fairly empowered to get out the kind of information that's relevant in these cases. And it also takes a multi-skilled thing. Don't put me in front of a fire extinguisher. I won't know which side is up. But I can maybe do something on the finance side. But that's the point, is we've got a nice complementary range of skills. Yeah. We need to spend the time with the client. And when we ask the clients, how would you measure your gross profit through your production cycle? At the work in progress stage, at the warehousing stage, at the distribution stage, where do you actually make the profit? Because you don't only have a fire in one place in the organization. So you need to then understand, where does the money make sense and how would you respond in various ways? And some clients say, well, we don't measure our GP differently. We say, well, guess what? You're going to buy a lot of insurance because we just have to declare this massive amount of risk, which is inefficient. But when we do it the right way and you get the granular analysis, there's enormous pearls of wisdom that come out of there, and then the clients benefit from that.
Historically, engineering was the basis of analysis. Where Ron and my teams were really at the forefront of that conversation. Now the fact that we integrate that with a financial opinion, which is what Volker and the other teams, the strategic teams, bring to the table. We've also got an analytical capability on the actuarial side, which does modeling for our clients.
Being non-compliant with regulations could also interrupt your businesses, could also stop your production to be taken, especially in the higher risks areas. You would be able to lose your operating license if you're not compliant with certain rules and regulations. That's another one.
Non-compliance and non-claim payment. Can you imagine that?
Same.
Or struggle on claim payment.
Yeah.
And just coming back to Chris's point, yes, we've designed an actual model where we blend risk exposures throughout the value chain with known loss experience. And very often, when you look at a modeling environment, people model claims. But if there's no data on claims, what do? Then there's an underwriter's judgment. We're the only ones who provide a simulation of potential exposures to the market, and we give the same data to reinsurers as they would use themselves. So we're actually talking on the same page with underwriters in terms of how they would price a risk. And that's a unique service.
What I'm hearing from the three of you is the future of this industry in terms of assessment is how successful you are in building that future modeling. Ron, what's your approach in that respect? How do you set about that?
One of the things we actively promote towards our clients is that they should take that step themselves, so that they should become self-aware of their risks. Many of our clients, even the larger corporates, have been dependent on external people, on the insurance inspector, who actually had an opinion and came up with suggestions and recommendations how to improve things. The legislator who came along, but what we are actually promoting, and with the help of the tools, etc., we have available, is think about what do you consider acceptable yourself for your business? Where do you think the risks are? And we provide them with the knowledge and expertise for them to take that position themselves.
But I always thought that self-awareness was almost like the 101 of risk management. And you're suggesting that people are not always embracing that with the alacrity that they should.
What Volker said before, I think a lot of the companies fell asleep because of the fact that they were properly insured and were considered, okay, our insurance company is happy with it, and it wasn't very important because the rates were low, the costs were low, so it wasn't at the attention of the CFO and the other guys in charge. That's changed. And they've been confronted, many companies have been confronted with the fact that somebody told them that they probably didn't have the capacity available, so they were partly uninsured. And suddenly the CFO thinks, okay, I might have an issue with my banks. So that the whole situation over the last couple of years brought the awareness up from the insurance and risk manager also to the C-suite of the company.
That's my next question. You were going to pick up on the C-suite. It's now become a priority agenda item.
And a lack of insurance is a directors and officers exposure item.
Yep.
So that, if you look at it and saying, excuse me, but tell me again why we didn't get 50 million of our claim paid. And if it's a listed company or there's some issues around that, it's a governance and, it's an execution risk, if you want to call it, at the D&O level. And so now there's a lot more awareness of saying, hey, why is it that we are struggling to get capacity, and the positioning of the client, and then recognizing that the market has hardened and saying, hey, let's use this in the context of let's not waste a crisis. Let's make sure that we're going forward and we can then leapfrog this negative sentiment. And if we reprioritize ourselves and reposition ourselves in the ranking of potential risks, we can then minimize this risk of being uninsured or underinsured. So there's a lot of assumptions about the soft market that Chris was talking about, that where people should have paid more attention of what was a correctly insured or uninsured risk.
Gentlemen, I want to start wrapping this up with a look at some practical examples, if we can. And maybe, Chris, as a starting point, where is the deficit in the supply chain when it comes to risk? What are some of the things that you're seeing? What are people not recognizing?
The first one is the surprises that we were faced with as a result of COVID. So everybody that had a business continuity plan thought it was as simple as picking up the phone during an emergency and getting a response from your supplier. But we found that that's not the case at all. So global logistics has become the number one issue that most international companies are dealing with. The ability to get your supplier to provide you with adequate supplies on time. And the issues we've seen around the Ukrainian war, with the delays in the ports, being able to ship things across, fly things across, these have all become big ticket issues.
And particularly at the tip of Africa, because of the geographical challenges that exist there. What have you noticed, Volker?
Yeah, to me is the supply. To me is also talent, resource. Is enough of the right work being done in the right places? Do people know enough about their risks up and down? So there's still at least a dearth of comprehensive analysis. And I think some of that nervousness of, are we actually properly insured for everything we should? And will we get another surprise like COVID? So in the strategic workshops, many of the aspirations are stated as, we don't want another COVID bad surprise. So let's look at our business again.
So are you able, Ron, to give us a couple of examples of where Riskonet has intervened in the space and made the critical recommendation on change or alternatives?
Yeah, I think we have one of the this process. This whole thing started in 2018. I think this market change, etc. We have had some clients where we already were able to convince the risk manager, to convince the C-suite that they should take those steps ahead of the market. We didn't know that market would be coming. And what we've seen with those clients, we've got one of our largest clients is a big mid-sized food company in the Netherlands with subsidiaries throughout Europe and some in the US. They got a new risk manager. The guy was really forward thinking, and we've been actually building with him this new philosophy. And then the market hardened. They had losses, significant losses, no issues at all with capacity. And even during the last renewal, which was still a hard market, the prices went down because we were able to show the markets, and we had the data to show the markets that they were on the right track and that they did all kind of investments. And they took their own position, their own stand, and they said, okay, we're going to invest, we're going to manage the companies differently, we're going to put our own standards in place. And that gave us the ability to connect with the markets directly, because we spoke to the insurers directly and say, guys, don't worry. We do this. We have had this loss, but we've now taken action. It will never happen again. We've been investing money in that facility and in that facility to bring the level up. And it simply worked. So you could actually show, although they had the losses, that the trust level was there with the markets, and they were able to support this company and the risk manager of this company.
So that's a very good example. Locally, does anything spring to mind?
We've been successful across agriculture, mining, logistics, leisure. Volker, the 6 or 7 that we're currently running now at the moment, where we've demonstrated to clients that if this new approach is adopted, how different they view risk in their business, and they're able to prepare for it in advance. The historical position of relying on the broker to come and ask you about your business to identify inherent risk in your business, those days are long gone.
Same question to all three of you. What's the call to action to risk managers in organizations in this new climate that you have outlined for me?
Take the steering wheel yourself and don't let them be taken by somebody else.
The money answer. Insurance is not an annual purchase. It's a life of mind, life of factory strategic decision.
To me, it's detailed analysis, taking care of the issues yourself. So do the detailed analysis, don't be reliant on third parties.
Valuable information from all three of you. Thank you very much.